Welcome to JM Financial Mutual Fund's Equity Outlook. In this short video, we would take a look at how different economic and market factors behaved in the recent past. We will also share our view on the Indian equity markets, which may in turn impact the positioning of our schemes. The Nifty index was up by 1.7% for the month ended May 2025. The Nifty Midcap 150 index was up by 6.3%, whereas the Nifty Smallcap 250 index was up by 9.6% in May 2025. Sector-wise, Nifty Media 13.0%, Nifty Realty 7.2%, and Nifty Metal 7.1% were the top-performing indices, whereas Nifty Fast-Moving Consumer Goods minus 2.1%, Nifty Pharma minus 1.5%, and Nifty Private Bank 0.5% were the laggards. Global indices ended the month of May 2025 on a positive note. Dow Jones was up by 3.9%, Nasdaq was up by 9.6%, while Financial Times Stock Exchange Group 100 was up by 3.3%. The India Volatility Index, VIX, saw decline in May 2025. It was at 16.08 compared to 18.22 in the previous month, down by 11.8%. The Chicago Board Option Exchange, CBOE Volatility Index 2 saw a decline in the month of May 2025 and was at 18.57 as against 24.70 on the previous month, down by 24.8%. Foreign institutional investor were net buyers for the month of May 2025. Net foreign institutional investor inflows were Indian rupees 14,683 crores. Domestic institutional investor bought stocks worth Indian rupees 67,642 crores, whereas mutual funds were net buyers worth Indian rupees 56,302 crores. Nifty 50 forward PE trading above mean PE. Nifty Midcap 100 is trading above one standard deviation above the mean forward PE. Indian equity markets continued their upward bias, with all segments of the market registering gains. Small caps and mid caps outperformed large caps, with some of the government-owned banks and defense companies gained handsomely. Corporate earnings suggest some improvement backed by increased government spending and recovery in domestic economy. Improvement in GST collections suggest that a recovery is underway. U.S. economy resets continue to create significant volatility in both markets and potentially corporate earnings, while liquidity conditions in India are improving, helping reduce interest costs. U.S. interest rates are spiking, reducing the likelihood of foreign capital flows. This makes markets more stock-specific and domestic-oriented than before. Corporate profits in Q4 FY 2025, financials disappoint, but revival in commodities and oil marketing companies and telecom. IT sector continues a lackluster growth as also consumer staples. Declining commodity prices could help boost consumption and reduce input costs for fast-moving consumer goods companies. Slow earnings growth is on the back of a slowdown in government spending, which we will discuss shortly. The headline Gross Domestic Product reading for fiscal year 2025 shows a clear moderation in growth when compared to the previous year. Also, the growth number for fiscal year 2025 has come in line with the pre-pandemic growth level, after achieving 7.0% plus growth in fiscal year 2023 and fiscal year 2024. Slower urban demand, lower government capital expenditure, and lackluster private capital expenditure led to a decline in growth in fiscal year 2025. The government capex has been a driving factor for domestic growth, especially after the pandemic. The government had expectations that the private sector would see a strong revival in capex through crowding in. However, the same hasn't been achieved so far due to lower visibility of demand and heightened global macroeconomic uncertainty. Moreover, the government capex slowed during fiscal year 2025, thereby adversely impacting growth. However, with March 2025 observing a significant increase in capex, the revised estimate was met for the year. The FY26 capex budget estimate had indicated a mere 10.1% growth, substantially lower than the 5-year FY21 to FY25 average growth of 25.3%. In some way, the government's focus has shifted more towards containing the fiscal deficit, even if that entails lower capex support. Pickup in GST collections indicates revival in domestic economy, and hence we remain optimistic of a recovery trade in corporate earnings. The recent push in capex by the government also leaves us optimistic that the drivers of earnings growth are in place. Further, the government's fiscal discipline has also improved liquidity infused by the RBI, sets the stage for lower interest rates, which act as a further fillip to growth. Recent corporate interactions. Our corporate interactions suggest that the headroom for growth is still significant in the following areas. Localization. Currently, Indian manufacturing is subscale in several areas, and higher cost of capital and lack of domestic markets have hampered this process. We are expecting significant investments both in listed and unlisted companies to make this happen. Government's policy making is still slower than expected. Delay in approvals and lack of timely decision-making is hampering capacity creation. Hence, most companies prefer either acquisitions or brownfield expansions rather than greenfield projects. Foreign investments undercloud as American tariffs derail manufacturing in offshore locations. Product development and research and development continue to receive a push in India by multinational corporations (MNCs). Deficiencies are an opportunity. The current shortfall in manufacturing scale and capacity highlight the need for large-scale investments. It will be incumbent on policymakers to create the right environment and tax incentives to make this happen. Companies with healthy balance sheets are expected to be at an advantage. Corporate capex cycle may appear sluggish, but as discussed above, India's economic growth over the past 5 years has been challenged due to several factors, COVID being one of them. We are optimistic on growth reviving. Key risks are U.S. interest rates and tariffs. The recent tax proposals in the U.S. budget will increase government borrowings, which are at close to 100% of gross domestic product. This created a spike in U.S. government securities yields, which could shift capital flows away from emerging markets and also increase the cost of equity, thereby reducing PE, price to earning multiple. Continued changes in policies have resulted in equity VIX, volatility index, increasing for a sustained period of time. Higher yields in the U.S. reduce growth prospects globally and also limits capital flows into emerging markets. This will mean that India will need to fund her growth internally rather than depend on external flows. This will also limit the extent to which the central bank RBI can reduce rates, and a depreciating US dollar could impact exports. Further, with the threat of tariffs limiting U.S. imports and reducing profitability, export-oriented sectors will need to be watched. Conclusion: recent revival in equity markets have been on back of continued domestic inflows and some inflows from foreign portfolio investments in recent months, which remains unpredictable. There are signs that corporate earnings are picking up and growth momentum will resume. Recent results indicate that growth has stabilized to nearly the same levels as the previous quarter. We are expected growth revival in earnings to continue on back of improvement in the economy and a favorable base starting Q1 FY26. Our portfolios have continued to demonstrate flexibility and resilience in face of volatility. We have had to balance growth, liquidity, and volatility. Markets have become more broad-based, and hence we have increased the number of stocks and reduced concentration risks. Earnings growth of banks have been lower than expectations, and hence we have a higher allocation to NBFCs and capital market beneficiaries. We are expecting the mid-cap outperformance to continue barring any liquidity event, and have therefore increased our allocation to the same. From an investment perspective, markets continue to remain expensive, but should earnings growth revive, then the current valuations may be justified. We have become more constructive on markets as all factors for growth are in place: good corporate and bank balance sheets, controlled fiscal deficits, and revival in job creation and personal income, which had been stagnant for some time. Volatility levels will remain high in light of global events, but need not deter India's economic growth. Investors to continue to maintain their equity allocations through systematic investment plans, SIPs.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.